Here, we believe that high net worth individuals and their professional teams shouldn't have to struggle to find great options for deferring capital gains taxes. Don't let your failure to plan become your plan to fail, especially when the Deferred Sales Trust may be one of your best ways to exit your highly appreciated assets and defer your capital gains tax so that you can continue to build your wealth. You are in the right place. I am not Brett Swarts. I am Jessica Lanning. I am filling in for him today. I'm an independent financial planner here in the San Francisco Bay Area. Each episode, we are joined by some of the leading wealth advisors, business and legal folks, real estate experts, and leadership specialists to share their ideas, tell their stories, and share their inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. Our next guest has been a certified financial planner for over 20 years. He's from Lowell, Arkansas, and the founder of Lighthouse Financial, a team of over 20 members, which serves clients across the country. He is a father of three, and when he's not working, he enjoys golf, water skiing, and like me, enjoys snow skiing. So maybe we can just talk about whether or not we're going to get any good snow this winter. Please welcome Lance Belline to the podcast. Welcome, Lance. Good to have you here.
Thank you, Jessica. Glad to be here.
Please tell us a little bit about you and your story so that our listeners can get to know you a little bit better. How'd you come to become a financial planner, and what are you doing these days?
Yeah, I would say it was probably a little bit more divine intervention how I got into the industry. It's not like I was growing up thinking I was going to become a financial planner. Right? I really had no idea what I was going to do. I'm always admire some young adults when they kind of know what they want to do in life. At age 15 or 18. And so I was not one of them. So I didn't necessarily have the best grades graduating college. I didn't network necessarily the best. And so I found the interviews I would have got would be in sales positions of some sort. And so one of those was to be a financial advisor. I didn't really know what that was, I would say. So that's how I got started in the industry. And, by just very fortunate that I was able to survive. And then, that later evolved where I became, a certified financial planner, and then later ended up starting my own firm. And, it is what it is today. So it's been a neat ride.
Nice. And what's your current focus these days? Who's your core client base?
Generally speaking, they're higher income and a little higher net worth individuals that are 80% probably are corporate executives. So being in Northwest Arkansas, we're fortunate to have Walmart is in our backyard, and then Tyson Foods and JB Hunt Trucking. So, and then the remaining 20% of our clientele are small business owners.
Very nice. So I also want to have you expound upon what you believe your special gifts are in either running your business or working with your clients. I believe that we all have intrinsic gifts that we bring as humans on the planet. And what are yours? What are your superpowers?
Well, I say my purpose in life really is to give people financial peace of mind and give them clarity regarding how they're going to accomplish their goals. I think there's enough in life that can cause stress, and I'd like to eliminate some of the financial stress that sometimes families have as far as, that they incur. And so I'd like to be able to remove that from the table so they can focus on what's important in their life as far as their family and other things. And then, our niche, came about around when I was 37. I formed a mastermind group of just other financial planners like yourself. And, say, hey, let's share best practices, ideas, concepts. And so that was when I kind of had an aha experience as far as a person from Seattle, Washington. His name is Rich Stewart. And he said, we need to think strategically about the distribution options or strategies when people are accumulating their wealth versus waiting until they actually get to retirement age. And it was something I never had thought of before. I was just typically doing, what I think most good planners do is just helping people save and invest so they accumulate enough to be financially independent or to put their children through college. And so I wasn't thinking about the distribution strategies, at that time. And so, that's kind of our niche now is helping people pay less taxes during their retirement years.
Got it. And look, Financial planners, we all, like, 'cause I'm a financial planner as well, right? We
Mhm.
all provide those services for our clients, but really
Yeah.
our clients choose us for who we are
Mhm.
and what gifts we bring, right? So what are those for you? Like, I see leadership in you. Like, no, not everybody just runs a firm. Not everybody has those aha moments and pays attention. So what do you see as your gifts? What are your unique abilities?
Yeah, I pride myself on trying to communicate in a way that people understand, right? I'd want to, be simple. So if they understand it, then they have confidence. And if they understand it, then they can act on that. So I tried to stay away from the financial jargons that, sometimes we can get caught up in doing. So I feel the way I communicate, it often relates well with individuals. And I pride myself on that.
Got it. So just being a good communicator and an
Mhm.
educator, I imagine too.
Yes. Being a behavioral counselor, I would say, is
Ah,
what I feel I try to focus on as well.
got it. Yeah, I make a joke often that I practice the unlicensed practice of marriage and family therapy in my office.
Yes, can
So
totally relate.
yeah, right. You get it. I knew you would. So the topic for today's show is more wealth, less taxes. I know you
Mhm.
want to talk a little bit more about the distribution phase and how people manage their taxes during their accumulation phase, so that they're prepared to do that when they are then in the distribution phase. So I'm gonna let you take it from here. Talk to us. What's your focus? How does that relate? And by the way, when you're doing this, let's get out of the jargon. What is accumulation phase and what the heck is distribution phase?
That's so
Go.
true. Yeah. So, in short, what I'm trying to do during when people are receiving income during their retirement years, they're no longer working, no longer have a W-2, or no longer have self-employment income. We can try to paint a picture that looks like something like this. Give them, let's say, $120,000 of income, as an example, and they pay less than $2,000 in taxes. Or another, concept is give them, let's say, just over $109,000 of income and they pay no taxes. And so that is kind of the I would say the result of strategically withdrawing from your different accounts that are based on how they're taxed when they make withdrawals.
Got it. So how are you setting this up for them? Boy, I would love to have $109,000 in retirement income and not have to pay any taxes on that. So how are you setting up clients to do that?
So we have to understand kind of how the tax code works without getting complex, right? You have income taxes on one side of the table and you have capital gain taxes on the other side of the table. And what many individuals are not aware of is that there's three tax rates on the capital gain side, and that is there's 0%, there's a 15%, and there's a 20% tax rate. But those are determined by where you fall on the income side. So if your income, for example, if you're fortunate enough to have income of 660,000 or more, you're now in a 20% tax rate on your capital gains. If it's less than that, but greater than 83,550, then you qualify for the 15% tax rate. And if it's less than 83,550, then you qualify for the 0% tax rate. But not very many individuals would like to make less than $83,500, right? When they're working and growing their wealth. But during the distribution or withdrawal stage, what we do is we limit or not withdraw at all money from what I call bucket one, which is your taxable bucket when you make withdrawals, like an IRA or a 401k. So that becomes your new W-2 in retirement. And so if we, for instance, don't take money from that, which we have, right, as you know, until age 72 before we are forced to withdraw from that category, then we have no W-2 income or we have no taxable income. And so then that's why we get the 0% tax rate. So from what I call your bucket two money, which is money that you had excess money and you invested it in stocks, bonds, or mutual funds, and hopefully you've made gains over the years, and then you can trigger those gains, and then those get taxed at 0% up to $83,550. And so the reason it gets to be 109,000 is because, as you know, every taxpayer qualifies for a standard deduction. Even if they don't give monies to charities, and that standard deduction allows individuals to take 109,000 minus 25,950, and that gets you below the 83,550. And so all of that gets taxed at 0%. And so that's kind of the concept. And then the other monies, if people want more income than that, then hopefully they've accumulated some wealth in that, what I call your tax-free bucket, which is a Roth IRA, that got introduced in 1996, or a Roth 401k, and cash value life insurance is another category, or health savings account. So then we can get income from that category, and it's not reportable as income. So kind of taking monies from buckets 2 and buckets 3 in retirement is how we lower the amount of taxes that individual pays during their retirement years.
Got it. So let's just clarify a couple things for our listeners, just so they make sure that they're following, because people are going to have to pull money off of their 401ks or their IRAs at some point in time.
Yeah.
And so what you're doing is managing the amount of money you're taking off of those accounts so that you're reaching those particular tax thresholds, and therefore lowering the taxes on another bucket of money, which is the capital gains taxes. Explain for people capital gains taxes. Like, what's the difference between 401k taxes and capital gains taxes? Why does this matter?
Yeah, so 401k taxes, or in retirement, is in essence, the best way I can explain it is your new W-2. It gets taxed as income.
Taxes like you were, as if you had earned it.
Yes, as if you earned it. And so that is what that's what the federal government kind of focuses on to decide how much your capital gains tax rate is going to be, right? Is it 0%, 15%, or 20%? So obviously people would like to have the 0% rate, right? And it just doesn't happen very often. They were not aware of it because, again, while they are working and making money, generally they were making more than that 15% income limit of 83,550. That's in today's dollars. So a lot of times, like you said, what we try to do is like, what if an idea is, how do we get money out of an IRA tax-free? Normally, you would say that's not possible. But again, if we take out the 25,900, which is your standard deduction. So if we take out that from the IRA, we then subtract the standard deduction, it brings your taxable income to 0. And so during those years up until age 72, we're definitely going to withdraw at least what's equal to the standard deduction, so we can get money out of that taxable bracket up to retirement. Up to age 72.
And talk a little bit about the power of that third bucket and the Roth IRA or Roth 401k, and how this supplements income for people as well.
Yeah, it'd be awesome. I'm not there yet, but when you can withdraw money or receive money from an account and you don't have to report it as income, or you don't have to pay taxes on it, it'd be amazing. I look forward to be able to get there in that place. But what's interesting also about that category is it's also not taxed, right, to our next generation, right, to our children. As you probably have experienced, sometimes individuals inherit money, and when they get a lot of that 401k money that's pre-tax, they're forced to withdraw it. And they're like, well, I don't need it, but it doesn't matter. They have to receive it. And so the bucket 3, I think, has been the best, category. I'm so glad Senator Roth in 1996 introduced it. But the government knows it's beneficial because they put income limits on it, right? Who could contribute? And they also create contribution limits. What surprised me, though, in 2000 is when companies could amend their 401k plans to allow, right, for Roth 401ks. But I'd love your input on this, Jessica. I was surprised because in 2020 is when Walmart amended their plan to add the Roth feature. Tyson Foods was in 2019. And I was like, why did it take so long for companies to disamend their 401k plan? Because that's 20 years is a long time. as you know, there's no income limits, right? It doesn't matter what your income is, you can contribute, and the contribution limit is greater. So I find a lot of individuals don't have as much wealth accumulated in that tax-free bucket because, one, it started late 1996. Then there was contribution limits, income limits, and it's and then cash value life insurance. We could probably, if we had 5 of us in the room, maybe you'd have 1 or 2 go, yeah, others said no. So, it's interesting, but we're trying to help people like think strategically now, since it's more equitable and they have access to it through their 401ks, then they can start accumulating money in that tax-free bucket.
Yeah, I don't understand why companies took so long to do that, because at the end of the day, their match goes into a traditional 401k.
Yeah.
So they're getting the deduction. Why would you not provide that benefit to your employees? I totally hear you about that. It seems like, boy, that's late to the game to change it in 2019 and 2020.
Yeah.
Why not do it sooner? Absolutely. I'm gonna let you hit this softball question too. Look, why reduce taxes? Seems like in retirement, you're going to be making less income. Isn't that the story that I always hear? Contribute to my 401k when I'm in my highest earning years, and then I'm not going to pay less in taxes in my, retirement years. If I buy into that story, what's the big deal about taxes?
Well, I'm not have a crystal ball, but my simple mind says that, and if you research this, your listeners can Google, right, federal historical tax rates. We actually, over the last 15 to 20 years, have been in a very low tax rate environment. Many people aren't aware that we've had a 90% tax rate in our history, a 70% tax rate, 50% in the 1980s. So I feel like if we diversify how our wealth is taxed in the retirement years, we're not dependent upon what the government tax rates are going to be 10, 15, 20 years from now, which with our federal deficit, many government programs being not very solvent, my simple mind says the government's going to need to raise revenue, and they're going to raise revenue through taxes. They could also decrease expenses, but politicians generally do not like to do that. So I just want to try to help people and myself get control of what tax rate I pay, versus right now I don't have that. Right, I'm told what I'm going to pay because of the way the tax code is written.
Yeah, I think people often too don't see how much they're paying in taxes, particularly if they're a W-2 employee, because all that money's taken out right before their paycheck lands in their bank account. And when they become retirees, they become acutely aware because now they have to write those checks themselves. And if you can lower that tax, in the line items of your budget, if you lower the taxes, you got more money to buy milk, metaphorically speaking. So yeah, I hear you about that. We do here at the Capital Gains, Tax Solutions, we are focused on really helping people who have highly appreciated assets to be able to defer those capital gains when they are able to, or when they want to exit those particular assets, whether it's real estate or it's cryptocurrency, art collections, it could, a business, right? Those are big ones for us too. So we're doing very similar things here, where we are just really trying to focus on how do you really get that line item of taxes as small as possible, so you've got more money to enjoy your life, because isn't that really what it's all about anyway, right? Enjoying life. Really living our gifts here on the planet. And you can always learn more about that at capitalgainstaxsolutions.com. You're also welcome to find me at jessicalanning.com. And for our listeners who are listening, would you please tell them how they can get a hold of you?
My website is Lance Belline, BELLINE.com. And that will have the link also for the book that I have coming out in November. And they can do a pre-order if they'd like. And there's some other resources on that website as well to kind of help individuals like, well, how much do I currently have in each bucket? And based on how I'm saving, what is it going to look like 10 or 15 years down the road? And so that's how they can get a hold of me. Is lancebelline.com.
You want to spell out Belline for them?
BELLINE.
Very good. And what's the book about? Tell us about that just briefly.
Yeah, well, it's just thinking of concepts and strategies to help people accumulate more wealth and pay less taxes over their lifetime. Is the general concept, especially during the retirement years, as I've been kind of speaking to. So, and other ideas, I don't know about you, Jessica, but it seems like if I could do it over again, right? If I could rewind the clock, knowing what I know now, I'd probably do things a lot differently. And so I have a lot of this concept of writing about that, that which is it's been fun to kind of remember and articulate those ideas.
Nice. Well, when the book comes out, maybe we'll have you back on the podcast. You can talk about it.
I'd love that.
All right. You ready for the lightning round questions?
You got it.
Okay. What's the favorite book or the book that you have gifted the most to people in the last year?
Last year, Extreme Ownership.
Do you know who it's by?
I do not know. Okay. I do not know who it's by.
Visit your local bookseller. Yeah. Extreme Ownership. Yes,
Extreme
did I get that right?
Ownership. Yes.
Very good. Yeah. What's your favorite leadership quote or theme that you strive to live by?
You're catching me in my weak spots, acting on impulse here, Jessica. That's my. I'd say, just do what's right, avoid what's wrong.
Very nice. Yeah, I noticed on your website you said live by the golden rule.
Mm-hmm.
Okay, so this is so funny. Imagine that you could go back in time. What would you tell your 25-year-old self?
Save earlier, right? Save versus spend.
Amen. Yeah. Early and often.
Mm-hmm.
What are you most curious about right now?
Well, I'm kind of curious. Obviously, it's the midterm elections are coming up, so to see how those are going to come out. The financial markets are a little bit in a crisis right now, so very intrigued by what that outcome is going to be and when the government's going to get our interest rates problem in check and our inflation in check. So those are the kind of the topics I'm mostly waking up some at night thinking about.
Yep, you and me both. You've had so much great success in your career. What's the one habit that you try to practice daily or weekly, which helps you stay centered in your values and keeps you moving forward towards new goals?
Consistency. I think just to be consistent in what I need to do on those daily activities in order to accomplish the goals that you have, on a weekly, monthly, quarterly basis, is what I would, look back and say that's kind of set me apart some in the industry.
Yep. Keep showing up.
Mm-hmm.
Listen, thank you so much for being on the show. I want to encourage you to keep using your gifts of communication and education to be a blessing to others and to help others. I really appreciate that about you. Again, for those of you who want to get in touch with you, what's the best place for people to find you?
Lance, www.lancebelline.net.
Very nice. Okay, that wraps up the show. I want to thank you, the listener, for listening to another episode of the Capital Gains Tax Solutions podcast. Again, we believe that high net worth individuals and their professional teams shouldn't struggle to find great options for deferring capital gains taxes. Don't let your failure to plan become your plan to fail, especially when the Deferred Sales Trust might be one of the best ways to exit your highly appreciated assets, defer those capital gains, and continue to build your wealth. Please remember to rate this podcast, review, and subscribe. We would love to have you back. And thank you so much, Lance, for being on the show today.
Thank you for having me.
You're so welcome.